Well, there's definitely an interest in terms of the current market environment and investors who are coming to the CTA space. I think a lot of them are really looking at what happened in 2008 as a backdrop. And so we've talked to institutions and investors who are actually just in the preliminary stages of looking to allocate to this space. And the problem with it is that, we feel that there's a lot of misconceptions surrounding this industry. So, for instance, we're talking to an institution that wants to allocate because of a non-correlation factor, but they're limited in terms of only one strategy, which is trend following. And so our point is to educate them and help them understand that within this umbrella of CTAs, there are different strategies out there that they should probably look at diversifying for a much more smooth portfolio curve. Traditionally, most of the CTAs out there were the trend followers, but what we've seen is a lot more interest for non-trend following type of strategies. So on one side you have these quantitative type of traders that might be short-term, systematic, that are looking for inefficiencies in the marketplace, and the other side you have the discretionary global macro type of a trader that has a certain expertise in maybe one market or a certain type of a sector. We at Balarie Capital are also seeing an increase in new CTAs that are coming to the marketplace almost on a weekly basis. We're having conversation with either traders that are looking at starting their own fund, traders that are looking to leave certain funds to start their own funds. So there has been an increase in demand from these emerging traders. With that, and with any growing industry, there are both pros and cons. The pros are that, look, there's a lot more options out there, a lot more traders. It's not just the 10 or 20 type of traders that we had, maybe 15, 20 years ago. The cons are that you have a lot of these traders that are coming up that aren't really qualified to manage money. And for your typical investor, or perhaps even sophisticated or even unsophisticated investors, they aren't as seasoned to understand, if this new trader or emerging trader even deserves an allocation. They might simplistically just search through a database, look at the returns, and like what they see, and then decide to make an allocation. And we think that's just a big risk. What we like to do, and it's a very simplistic kind of formula when we look at some of these new traders or emerging managers that do come out, we look at 3 factors, and we won't even look at them if they don't have 2 of these 3 factors. The first is pedigree. Are they coming from another large firm? Have they traded on Wall Street? Do they have a background and experience in that? The second is assets under management. Do they have something at least sizable? Do they have at least $50 million under management? And the third is track record. Is their track record at least 3 years long? So if they have 2 of the 3, for instance, they might not have the pedigree, but they've been around now for 3 years and have $50 million under management, clearly trading at least a decent amount of money, they're worth a shot for us to look at them. And so that's our approach. It's not a surefire technique of making sure, but it at least allows us to quickly kind of monitor some of these traders that approach us. I think the growth is pretty positive for the CTA space. We are looking at interest from a wide array of investors. And we're having conversation with wealth advisors that are realizing that they have to reconsider how they allocate the portfolios for their clients in terms of the different asset classes and what have you. We're seeing, as we mentioned, pension funds who are also looking at it from a non-correlated perspective. So we're seeing this growth. So we continue to believe that we're going to see a growth in terms of assets and exposure and interest into this space. I think, though, it's equally important for investors to not just have an arbitrary allocation to manage futures and think, let me allocate to this one CTA or let me allocate to this one managed futures mutual fund and think that it's a sufficient sort of portfolio diversifier, because correlations are constantly changing. Trading strategies are constantly evolving, markets are constantly evolving. So it has to be an ongoing evaluation of the CTA portfolio in conjunction with the client's overall portfolio. Yeah, what we typically do, like as an example, if we're looking at constructing a diversified multi-manager portfolio for clients, we try to focus from both a qualitative and a quantitative perspective on an individual manager basis and on the portfolio basis. So we know these managers that we look at, and we just know, say, intuitively, and just from discussion and talking to them and looking at what they trade, that they're different. You know, you might have like I mentioned before, a discretionary grains trader that knows the markets really well, has traded in the pit or what have you, and that's his expertise. And another manager might be your typical systematic trend follower that has several different programs trading simultaneously. And so that's a first step. And you look at those managers and you talk to them. You see how much risk they're taking. Even more so, and I keep on touching about this with the discretionary traders because it's not as rule-based as you would like. But then the second step is when you're constructing this portfolio and you're trying to put together these managers, you want to also look at the average pair correlation of each manager internally with each other. So I've had countless conversations with traders that say, listen, I'm different. I'm not a trend follower. I have a different program, or this is what I do. I'm unique. And then we look at their returns and their correlations, and they have a pretty high correlation to the other trend followers. That we know for a fact that they're trend followers. I don't really care what they call themselves. And so when we put together these managers and the portfolio as a whole, we then try to have a rule-based approach of how we allocate to the traders. So again, it's not arbitrary, and we just can't say, well, we like trend followers, let's have a 20% allocation, let's have a 20% allocation in global macro and credit, it's not credit, but spread trading and what have you. We try to combine it from the perspective of giving lower risk managers higher allocation, giving managers that have lower volatility with higher risk-adjusted returns, a higher allocation, giving some greater allocation to managers who have longer track records because they've been around. So that's something that we have to focus on. And we have several different factors that when investors come to us, they can see that we put together the portfolio in a very thoughtful and efficient kind of way. So can an average investor do this at home? Sure, but it takes time. It's a full-time job for them to be able to, I think, properly put together a portfolio and monitor it real time.